Believe it, money can feel small, but at $20,000, everything changes. Not magic, strategy. I'm Naruto Uzumaki, and today, I'll show you why crossing this line is like learning a new jutsu. Your choices get stronger, your risk gets smarter, and your future starts responding to you. In 15 minutes, you'll get 1. The mindset shift. 2. The safety rules, what to keep liquid. And 3. The growth moves, where to invest thoughtfully after $20,000. I'll also share exact examples, real data, and ninja metaphors so it's easy. But first, this video is for education only, not financial advice. I'm not a financial advisor, just sharing strategies inspired by Naruto's mindset and real-world financial principles. Always do your research or talk to a professional before making big money decisions. So grab your kunai, or, your notebook, and let's start this journey responsibly, with clarity and with a proper disclaimer. Why $20,000 and not $19,000? Because numbers are anchors for action. $20,000 is big enough to be a buffer, small enough to be reachable with disciplined savings. Think of it like getting your first strong clone. Suddenly, you can do twice the work. Here's real context. The typical American household has about $8,000 in transaction accounts. That means $20,000 is definitely above the typical starting point, and that's why hitting it feels powerful. Step 1 after $20,000. Build an emergency fund. Experts recommend 3 to 6 months of essential expenses in cash or very liquid accounts. That's the difference between stress and strategy when life throws a kunai at you. Look, not everyone has this buffer. Surveys show only about half of adults report having enough saved for 3 months of expenses. That's why getting to $20,000 is a turning point for a lot of people. The first thing that actually changes after $20,000 is your mindset. You stop reacting and start planning. Instead of being fearful about a $500 surprise bill, you can think strategically. Invest, grow, train. Important. Your emergency fund must be safe and liquid, not locked in a volatile stock that could drop 20% the day you need cash. Keep immediate cash in a savings account, money market, or short treasury bills. Let's do ninja math. Historically, broad U.S. stocks have returned approximately 10% annualized over the long run. If you invest $20,000 and it averages 8 to 10% over time, that can become a powerful engine. But remember, returns vary year to year. You wouldn't send just one clone into a mission. Tell the same to your money. A simple core portfolio after $20,000 could be 60% broad stock index, 20% bonds or short-term treasuries, 20% liquid cash or short-term bonds, adjusted for your age and job stability. Action plan. 1. Cover emergencies. 2. Pay off any high-interest debt, like credit cards. 3. Max or contribute to retirement accounts, 401k/IRA. 4. Invest the rest in low-cost index funds. If you carry high-interest debt, sometimes the best investment is to pay it down, a guaranteed return equal to the interest rate. But if your debts are low rate, investing some of the $20,000 can outperform over time. Example A, conservative. For someone with uncertain income, more bonds/cash. Example B, growth. Younger or stable job, heavier in stocks. The same $20,000 applied differently based on your situation. Don't try to time the market. Use dollar cost averaging. Invest a fixed amount each month. It smooths the ride and removes emotion from timing decisions. With a real buffer, you can take smart opportunities. Start a side hustle, take a paid course that increases earnings, or save a down payment for property. $20,000 gives optionality. Protection matters. Insurance where appropriate, keep your accounts secure, and have basic legal documents. The last thing you want is to lose money to an avoidable mistake. Use tax-advantaged accounts. If your employer matches 401k, that's immediate return. HSAs are triple tax favored for health and long-term savings if eligible. Don't get greedy. Avoid get-rich schemes, high-fee funds, and emotional buying during market swings. Protect your mental state so you can stick to the plan. Maya had $20,000, used it to create a 4-month emergency fund, paid down credit cards, and invested the rest. 2 years later, she had the confidence to quit a toxic job and start a freelance studio. Not luck, planning. Compound interest is your long-game jutsu. Small, consistent actions grow huge over time. $20,000 isn't a finish line. It's the fuel for decades of growth if you invest wisely. Your quick playbook. 1. Lock 3 to 6 months in liquid accounts. 2. Clear high-interest debt. 3. Max employer match. 4. Build a low-cost index core. 5. Keep insurance and lock down accounts. If you're under $20,000, don't get discouraged. You can train to get there. If you're at or above it, use it with intention. Start today. Pick one action. Secure 1 month of expenses or move $200 per month into an index fund. Believe it.